I am so incredibly thrilled to welcome you to today's custom-tailored deep dive. We built this specific analysis just for you.
Which is great because we're focusing on a subject that usually feels like it, belongs in a sci-fi movie or maybe a theoretical physics seminar.
Yeah, exactly. We are talking about quantum computing, but today we aren't just looking at abstract theories. We are looking at hard financial numbers, massive real-world strategic moves, and trying to answer one, well, multi-billion-dollar question.
Right.
Is IonQ a good investment today?
It is arguably one of the most fascinating questions in the tech sector right now. And to answer it thoroughly, we're relying on a very specific, data-heavy stack of sources.
Yeah, we've had the goods today.
We do. We are pulling directly from IonQ's Q4 2025 earnings call transcript from the Motley Fool, and that's dated February 25, 2026.
And we are cross-referencing that with current market beat analyst ratings as of today, which is March 11, 2026. Plus, recent company press releases, a detailed strategic presentation regarding a major pending acquisition, and just some baseline background on their specific trapped ion technology.
And their corporate history. Because whether you are prepping to adjust your own portfolio or maybe you're evaluating the broader business landscape of next-gen tech.
Or you're just insanely curious about how quantum computing is actually being commercialized.
Right. This deep dive is going to cut through the noise.
Yeah.
We are skipping the overwhelming jargon and figuring out what is actually going on behind the scenes.
Because the reality is, IonQ is no longer just a research project spinning its wheels in a university lab. I mean, they're reporting historic revenue.
That transition from lab to enterprise is the core theme we have to unpack today. And my goal here is to maintain a strictly calm, analytical approach.
Which is needed because there is an enormous amount of hype surrounding quantum technology right now.
Exactly. And we need to separate that from the actual business fundamentals. We're going to look closely at their technology mode, the massive geopolitical angles at play with their recent supply chain moves.
Which are wild, by the way.
They really are. And ultimately, what Wall Street analysts actually think about their current valuation and future prospects.
Okay, let's unpack this by starting with the financial reality, because I was looking over that February earnings call transcript, and the top-line revenue jump is, it's frankly staggering.
Definitely not what you normally see.
Right. It is rare to see this kind of exponential growth outside of early-stage AI startups. For the fourth quarter of 2025 alone, their revenue hit $61.9 million. What is actually driving a 429% year-over-year jump like that?
But it really comes down to a fundamental shift in their customer base. For the full year, they reached $130 million in revenue. That was a 202% year-over-year jump. And critically, they beat their own internal guidance by a full 20%.
And 20% beat is huge.
Yeah, but the key metric buried in those numbers is that over 60% of that revenue came from commercial customers. This is a massive shift.
Oh, because in the early days of quantum, revenue was almost entirely driven by government research grants, right?
Government grants and academic partnerships, exactly.
Thank you.
Now, enterprise clients are the primary drivers. Furthermore, international sales crossed the 30% mark for the first time.
Proving their commercial reach is actually global.
Right.
Let me play devil's advocate for a second, though. Top-line revenue is great, but in a nascent industry, how much of that is just pilot programs? Companies tossing a few $1 million at IonQ just so their board of directors can say they are exploring quantum.
That is the exact right question to ask.
If we are evaluating this as an investment for you, the listener, we need to know if this revenue is sticky.
And that brings us to the most crucial forward-looking metric in their financials, the backlog, or what the accountants call remaining performance obligations, or RPO.
Okay, RPO.
If this were just companies running small one-off pilot tests, the backlog would be flat. Instead, IonQ's RPO jumped from $77 million to an astounding $370 million in a single year.
Wait, so a nearly five-fold increase in committed future revenue?
Correct. And why this matters to you as an investor is that it demonstrates long-term structural demand. This backlog is built on massive, multi-year deals.
Like the Quantum Basel one.
Exactly. The sources detail a $60+ million agreement with Quantum Basel in Switzerland. That deal isn't just for current tech. It is to support 4 generations of future IonQ systems.
And they also secured a major win with KISTI in South Korea.
Which proves their land and expand strategy is actually working. They get a client in the door, prove the utility, and lock them into multi-year, multi-million-dollar upgrade cycles.
But, and this is a big But pioneering a completely new era of computing is not cheap. When we look at the balance sheet, it is definitely not pure profit.
Not at all.
Their adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, was negative $186.8 million for the year. And our R&D investment exploded to $305.7 million.
Which is a 123% increase.
They are burning a tremendous amount of cash to build out this infrastructure.
They absolutely are operating at a substantial loss as they scale. But that is typical for a hardware-heavy, deep tech company.
True.
But before we move past the financials, there is a very specific, frankly bizarre quirk in their GAAP reporting that we need to clarify.
Oh, the warrant thing.
Yes, because if you pull up their official income statement, you might be very confused. IonQ actually reported a $753.7 million positive GAAP net income for the fourth quarter.
Which sounds completely contradictory when you just said their adjusted EBITDA was negative $186.8 million for the year. How do you have a massive operational loss but report $750 million in profit?
It is a perfect example of how accounting rules can obscure operational reality. That positive net income was purely due to a $950 million non-cash mark-to-market warrant adjustment.
Okay, break that down for us.
To put it simply, early in their history, IonQ issued warrants. These are essentially financial instruments that give the holder the right to buy stock at a specific price later.
Right.
Accounting rules require companies to constantly recalculate the value of those warrants based on the current stock price. If the stock price fluctuates in a certain direction, the liability on the balance sheet drops.
And that drop has to be recorded as income.
Exactly. It is a paper gain. It does not mean IonQ sold an extra $950 million worth of quantum computers.
That is incredibly helpful context. It prevents a potential investor from looking at the headline net income and making a wildly misinformed decision.
Precisely.
The operational reality is the cash burn, but they can afford that heavy burn rate right now because of their war chest. They ended 2025 with $3.3 billion in cash, cash equivalents, and investments.
That $3.3 billion is the bedrock of their entire strategy. That level of financial firepower allows them to sustain heavy R&D losses without facing any immediate existential threat to their operations.
Yeah, that's a nice cushion to have.
But more importantly, it gives them the capital to execute a highly aggressive strategic pivot. They aren't just hoarding that cash. They are actively buying their way to a complete vertically integrated ecosystem.
That cash pile is funding what looks like one of the most aggressive acquisition sprees we've seen in the tech sector recently, which really speaks to their underlying technology moat and their pivot to becoming a merchant supplier.
Let's break down the tech foundation first.
Yeah, so we know IonQ uses a trapped ion architecture, relying on lasers to manipulate individual atoms as opposed to the superconducting qubits used by competitors like IBM and Google.
Right.
Since our audience is familiar with the basics of these architectures, let's focus on the commercial implications. Why is trapped ion winning these massive enterprise contracts right now?
It comes down to stability and error reduction. In the earnings call, IonQ management pushed hard on their two-qubit gate fidelity, claiming they achieved 99.99%.
Let's pause there because fidelity is one of those terms that gets thrown around a lot. What does 99.99% actually mean for an enterprise client trying to run a logistical algorithm?
Think of a quantum operation like a massively complex game of telephone. Every time qubits interact with each other, which is called a gate operation, there is a risk of the information getting garbled by environmental noise.
Like static.
Exactly. If you are running a highly complex optimization algorithm for global shipping routes, even a tiny error rate in those interactions compounds exponentially, until your final output is essentially random garbage.
So hitting 99.99% fidelity means IonQ has almost entirely eliminated the static on the line.
Yes. The qubits are staying stable long enough to run deep, commercially relevant algorithms without losing the thread.
And IonQ is claiming this translates to massive speed advantages for specific use cases. The transcript notes they claim to be up to 10,000 times faster than leading superconducting systems for signal processing and optimization tasks.
And that time to solution is what a logistics company or a financial firm actually cares about.
Yeah, they don't care about the lasers or the vacuum chambers. They care about how fast they can price a complex derivative.
Precisely. And this leads directly to the major technical milestone they just announced. They reached an algorithmic qubit score, or AQ, of 64 on their Tempo system, achieving this 3 months ahead of their own schedule.
Here's where it gets really interesting, because an AQ score isn't just about how many physical qubits you have crammed onto a chip.
No, the AQ metric is specifically designed to account for error correction. It represents the number of highly reliable, usable qubits available to actually run an algorithm.
And to put AQ64 into perspective, the sources use an incredible analogy to highlight the scale.
It's staggering.
An AQ64 system operates in a computational space 36 quadrillion times larger than IBM's current public quantum systems. If you wanted to simulate what the Tempo system can do at AQ64 using classical computing, you would need 1 billion classical GPUs.
We are firmly crossing the threshold where classical simulation is simply no longer physically or economically possible.
So the technology is working, and the computational space is scaling exponentially. But what is fascinating is how management is leveraging this technological lead. They are fundamentally changing their business model.
Yes, this is key.
They are transitioning from being a company that builds a boutique quantum computer in a lab into a merchant supplier and a full-stack platform. What does that actually look like in the marketplace?
What's fascinating here is it means they are monetizing the individual components of the quantum revolution, not just the final computer.
Yeah.
They have realized that the underlying tech required to build a quantum computer has massive commercial value on its own. For example, they are selling precision atomic clocks. In a recent partnership with DARPA, they managed to shrink the size of these atomic clocks by 6 times.
Which is critical because you can't launch a massive room-sized atomic clock into orbit.
Exactly. By miniaturizing them, they can now be mounted on standard satellite payloads. Beyond clocks, IonQ is selling quantum networking equipment and quantum sensors.
They are essentially becoming the arms dealer for the broader deep tech industry, selling these highly specialized components to their own competitors in the quantum space, as well as to defense contractors.
And for the enterprise clients who do want the actual computing power, IonQ is making it incredibly accessible.
Right. They recently unveiled Forte Enterprise. That's designed to mount their quantum systems directly into standard enterprise data center racks. They aren't forcing a Fortune 500 company to build a specialized cryogenic lab.
Plus, they have made their systems available on all the major cloud networks: Amazon Web Services, Microsoft Azure, and Google Cloud.
That frictionless accessibility is a massive competitive moat. If you want widespread commercial adoption, your next generation technology has to integrate seamlessly with the legacy IT infrastructure that these massive corporations already rely on.
Which brings us to how they are securing that infrastructure. And it is a perfect time to talk about how they are spending that $3.3 billion cash pile.
They are on an absolute shopping spree, aggressively buying up the puzzle pieces needed for this full-stack merchant supplier model.
The sheer volume and scale of their acquisitions over the last year is unprecedented in the quantum sector.
Let's run through the list because it is extensive. They acquired a UK-based startup called Oxford Ionics for over $1 billion. They bought Capella Space, which is a satellite imaging company, for $311 million in stock. They also snapped up Quibitech, ID Quantique, LightSync, and Vector Atomic. I can understand buying other quantum startups, but why is a quantum computing company spending hundreds of millions of dollars on a satellite imaging company?
The Capella Space acquisition is a perfect example of their broader strategic vision. They didn't buy Capella for the imaging. They bought the satellite infrastructure to build out space-based quantum key distribution networks.
Ah, okay.
Essentially, they are building an unhackable global communications network using quantum entanglement relayed through satellites. The other acquisitions, Quibitech, LightSync, Vector Atomic, they all fit into this matrix of networking, sensing, and highly precise positioning.
But the crown jewel of their entire M&A strategy, what management themselves are calling the largest acquisition agreement in quantum history, is their pending deal to acquire SkyWater Technologies.
This is massive.
SkyWater is a traditional semiconductor foundry. Why does IonQ need to own the factory that prints the chips?
If we connect this to the bigger picture, the answer is supply chain security and geopolitics. We are in the middle of a global space race for quantum dominance. Acquiring SkyWater gives IonQ something incredibly rare and highly coveted: a Category 1A Trusted Foundry accreditation from the United States Department of Defense.
So this is entirely about locking down government contracts by guaranteeing a secure supply chain.
It is about creating a completely closed, verifiable loop from design to fabrication.
Yeah.
Right now, global supply chains for advanced microelectronics are highly vulnerable. Chips are designed in one country, fabricated in another, packaged in a third.
Yeah, it's a mess.
By acquiring SkyWater, IonQ fundamentally onshores their U.S. quantum manufacturing. It insulates the company, and by extension the United States and its allies, from global supply chain disruptions.
Just to be clear for you, the listener, we are analyzing this strictly through the lens of market dynamics as presented in their earnings call and strategic presentations. We aren't taking a stance on the geopolitical friction itself.
Of course not.
The objective reality of the business landscape is that sovereign defense contracts are incredibly lucrative. Creating a completely secure, trusted environment where the Department of Defense can buy hardware without any fear of foreign espionage embedded in the silicon is a massive, multi-billion-dollar competitive advantage.
It is a brilliant, aggressive move to capture domestic defense spending. They are positioning themselves not just as a tech vendor, but as critical national security infrastructure. However, it is vital to acknowledge the monumental operational risk this introduces.
Right, because fusing a UK-based quantum startup, a satellite communications company, and a massive legacy US semiconductor foundry all at the same time sounds like an absolute logistical nightmare.
It is the ultimate test of their executive team, integrating vastly different corporate cultures, merging distinct tech stacks, and managing the daily operations of a legacy foundry while trying to invent next-generation quantum chips is incredibly difficult.
If they mismanage this integration, that $3.3 billion cash pile will evaporate very quickly without yielding the synergies they promised Wall Street. So what does this all mean for the stock price today? Let's look at Wall Street's verdict based on the current market beat data as of March 11th, 2026. Currently, IonQ is trading at $34.31 a share.
Oh, hi.
The consensus rating from the 16 Wall Street analysts covering the stock is a moderate buy. That breaks down to 9 buys, 6 holds, and 1 sell. But the consensus price target is the number that really jumps off the page. $69.45. That represents a massive 102.41% forecasted upside from where the stock sits today.
A forecasted doubling of the stock price indicates a deeply divided Wall Street, which is exactly what you would expect for a company attempting to commercialize a nascent, highly complex technology.
Yeah, that makes sense.
To give you a truly balanced view, we need to break down the specific arguments of the bulls and the bears.
Let's start with the bulls. The analyst at Benchmark just reiterated a buy rating with a massive $100 price target. That is nearly a 200% upside. What are they seeing that gives them that much confidence?
The bulls are looking heavily at the commercial validation and the balance sheet. They see that $370 million backlog as proof that enterprise demand is real and sticky.
And the cash.
Yes. They look at the $3.3 billion cash runway and realize IonQ has the financial stamina to outlast competitors who are relying on tighter venture capital funding. Most importantly, they believe the merchant supplier pivot is working.
They see IonQ building an unmatched, vertically integrated moat.
Right. If IonQ controls the satellites, the foundries, the enterprise rack integrations, and the atomic clocks, they become the foundational infrastructure layer of the entire quantum economy.
But SecDex are definitely making their voices heard. Wedbush reiterated a sell rating, and Rosenblatt recently lowered their price target down to $35, which is basically flat to where it is trading right now. What has the bears so spooked?
The bear case is entirely focused on cash burn and execution risk. As we discussed, management guided for an adjusted EBITDA loss of negative $310 million to negative $330 million for 2026. That burn rate is actively accelerating as they scale. Furthermore, the bears are highly skeptical of the M&A strategy. They believe that successfully integrating SkyWater, Oxford Ionics, and Capella Space simultaneously is nearly impossible.
They fear that management will become distracted by the logistical headaches of running a traditional foundry and managing satellite launches, losing focus on advancing the core algorithmic qubit milestones.
And if the AQ scaling stalls, because management is stretched too thin, the enterprise contracts in that backlog could evaporate.
So, synthesizing all of this data from the earnings call, the strategic presentations, and Wall Street's divided forecasts, here is the distillation for your portfolio.
IonQ represents a classic high-risk, incredibly high-reward scenario.
On one side of the ledger, you have best-in-class trapped ion technology, record-shattering 429% quarterly revenue growth, a massive $370 million backlog, and a fortress balance sheet of $3.3 billion that is literally allowing them to buy their entire supply chain.
And on the other side of the ledger, you have an accelerating cash burn projecting over $300 million in losses next year. Daunting operational execution risks associated with integrating a massive legacy semiconductor foundry, and the sheer inherent unpredictability of an entirely new technological frontier.
Investing here requires a multi-year horizon and a strong stomach for short-term volatility. You are fundamentally betting that this management team can execute on a highly complex, vertically integrated vision without stumbling over their own rapid expansion.
It is a phenomenal case study in deep tech commercialization.
It really is. We started today looking at a historic financial blowout that proved quantum has left the lab. We explored the technological moat of 99.99% fidelity and the pivot to a full-stack merchant supplier.
We unpacked the geopolitical strategy behind acquiring Skywater to secure sovereign defense contracts.
And we examined a deeply divided Wall Street trying to price in the future of computing.
It is a comprehensive picture of a company at a critical inflection point in its history. But before we wrap up this deep dive, I want to leave you with a final thought to mull over, building on the implications of their recent moves.
Laid it on us.
We talked extensively about IonQ mounting quantum systems into standard data center racks, shrinking atomic clocks for satellite deployment, and building space-based quantum key distribution networks.
Right.
Consider what happens when this integration is complete. What happens when quantum technology is no longer an exotic, isolated experiment, but a basic, invisible layer of our everyday internet and global infrastructure.
Wow.
If unbreakable quantum networking becomes the new standard, how will that suddenly and completely redefine what security even means for every single company, financial institution, and government on Earth?
That is an incredible thought to end on. Imagine waking up and realizing the fundamental architecture of global digital security has shifted overnight, and one company owns the supply chain that built it. Thank you so much for joining us on this custom-tailored deep dive. We hope this analysis helped cut through the hype and gave you a clear, actionable picture of the quantum business landscape. Keep learning, stay curious, and we will catch you on the next deep dive.